and welcome to this special 11 a.m. on a Thursday edition of Freightonomics. For those of you that are tuning in live, Zach Strickland, head of Freight Market Intelligence, Michael Rudolph, researcher for Firecrown, and we are going to be discussing, of course, the topic of the week, all the tariffs that are going on and a lot of the economic fallout, as well as some of the supply chain impacts and influences that are occurring there. There's a lot of confusion in the market, both transportation and the financial space and lots of other places that we're going to try to parse through. Certainly, I don't know that either of us claim to have all of the answers, but hopefully in that we can layer in some data and some insights here that help a lot of people just get through their day.
Yeah.
So with that, thank you for joining us today, Michael Rudolph. It's been a wild week from the headline standpoint, but I think my big takeaways are that we're just going to have to deal with a little bit of chaos here in the near term, correct?
Yeah, so you said that tariffs were the topic of the week, and I just couldn't help but think, it's been a long week.
Yeah.
I feel like I've been talking about tariffs for months now.
Right.
And there is a lot of uncertainty baked into, how the current administration will affect their trade policy, but, you're going to have to kind of ride with it. I think that's what a lot of people are doing,
Mm-hmm.
and we're seeing kind of the in real-time adaptation. The good news is that the domestic trucking industry appears to be relatively insulated from the shocks. If not insulated, but like there will at least be a delay
Right.
before the pressure points.
Yeah, I think since the freight market itself, especially to my logistics service provider segment out there, the brokers and carriers, you guys have been in an economic recession for your own sector for a long time now. It is getting better, slowly getting better. We're seeing green shoots and things like that. They're certainly showing up more on some of these earnings calls from these large enterprise carriers and enterprise fleets, but we're not necessarily through all of it yet. And I think the layering in of the economic uncertainty is just another reason that this may extend kind of a little bit of that. Now, we haven't seen it necessarily yet. So I think the first thing to do is start things off with the market in two.
Absolutely. Ready for me to count down?
Let's do it.
All right, 3, 2, 1, let's go.
All right. First up, the OTVI, Outbound Tender Volume Index. Last time we talked about this, we had a little bit of a dip in the OTVI in the middle of February. This is a seasonal exacerbation. We kind of dismissed it as not necessarily related to anything economically, but more of a fact that we had a Lunar New Year pull forward, a little bit of timing of that showing up and then strengthening as the market kind of came out of this period of time. Now, it's not looking great today. I'm not saying that we have recovered our volumes necessarily. We are well below. We're about 9 to 10% below year-over-year levels. Overall, a recent dip there coming into March. But demand is not the only part of the equation that I'm concerned about here. So let's move on to, the maritime sector. Let's look at demand here. And you see the upstream influence. IOTI, of course, measures the bookings data from shipper to the people all across the world for containers moving on boats coming into the United States. This index is showing resilience. So there's still plenty of goods. There's lots of freight coming in the United States. We're exceeding year-over-year levels, even when you adjust for the timing of Lunar New Year. We're still above 2024, and it looks like that strength is going to persist, at least in the near term. If we move back into the domestic truckload environment and look at outbound tender rejection indexes. This is why logistics service providers don't necessarily need to be concerned, and transportation managers may need to keep, this year's tightening in line or in mind. Tender rejection rates jumping up. That is on dropping in demand. Now, they're not dropping up to a chaotic level, but they are up over 6%, and this is kind of the story, is that even with demand, demand has been down for the last month. It's not manifesting into a market or an environment that is necessarily softening. So this is definitely a sign that we have seen meaningful amounts of capacity leave the market. Demand going down isn't having the impact that we thought it would or possibly should.
Yeah. That's one thing that I was noticing, though, is that we have seen, capacity leave the market indisputably. We get this from all kinds of data sources. I was just mentioning the ADP private sector employment report the other day. The transportation industry sector was blown out. I think it lost, a net 33,000 jobs in the month.
That's insane, by the way.
Yeah, it's nuts. There is some kind of, we're talking about seasonality and a return to that. We see that, I think, most in demand. not in tender rejections. They're marching to the beat of their own drum. But what we haven't really seen yet is a meaningful increase in spot rates.
Right.
And that's the one thing that I would like to see, because you see tender rejections, shoot up. Of course, you expect spot rates to follow. So
yeah, and I think sometimes you see what we're seeing with there's a lot going on at the detail level for the spot market itself. We're not necessarily seeing aggregate spot rates increase. If we can pull up the chart of the NTIL, the National Truckload Index, line haul only. This is an aggregation of dry van spot rates. Some mixing can happen here to make these really hard to compare year over year, or even from a historical perspective, especially when you're talking about inflation, cost inflation and things like that. We're about on par with where we were a couple of years ago with this index. The absolute value isn't that meaningful. The direction, however, is. And the fact that we're still kind of dropping on the spot market. Now, that doesn't mean that we're dropping everywhere. Something that we've noticed in our back-end data is that, or when you look at lane level data, is that there are some spots that are absolutely seeing meaningful increases in spot market activity, or spot rate activity, I should say. And it's happening not necessarily in the lanes that you would, I guess maybe I would expect, but maybe not the gross majority would expect. It's going to be Jacksonville to West Texas, upstate Minnesota, down into South Georgia. Lanes like that are irregular, that don't have a lot of consistent volume in them. Carriers are not covering those as consistently as they were when we were in a dramatic oversupply. So this is just one of those nuances of this market that we're starting to see percolate. We're seeing regional explosions of spot rates. They die out. They don't last for a really long period of time because there's still, I would say, sufficient capacity to cover most of it. And that's kind of been the story. We're seeing these percolations. This is what you would expect from a transitory environment going to a tightening market.
So on these lanes that are, not really the belle of the ball here, they're kind of irregular. Are you suggesting that the carriers are kind of abandoning the freight there and ready to go to like the major players like Dallas and Los Angeles? And so then the rates are coming up accordingly to entice the carriers to just, hey, move this for me, please.
And that's what the spot market is that basically, hey, most carriers don't like to go into the state of Florida. So they're going to increase their rates to go into Florida. So you're going to have to pay a premium to go into a state where there's just not enough outbound freight to cover for a carrier, because they lose money when they haul. For most freight coming out of Florida loses money for a carrier directly.
So even if we don't see this reflected on a national scale, at least what we're seeing is that carriers do have some pricing power, which was not the case, a year ago, 2 years ago.
Exactly. Right. So I want to pull up the map of the WRI, the weighted rejection index. This takes into account market share, so total volume, relative volume by market in the United States. So Dallas is one of the larger markets in the United States. A rejection rate increase there is way more meaningful than a rejection rate increase in Green River, Wyoming, for instance. So this helps account for some of that disparate volume. If we look at the map here, this is normally not this dark blue. And we saw the rejection rate, national rejection rate increase. Well, the markets that are influencing that the most, Charlotte, Dallas, Oklahoma, Oklahoma City market, Houston, and over in the Carolinas, Columbus, all having meaningful tender rejection rate increases when you look at it on a national level. So it's, again, not necessarily that the entire market is exploding with activity. There's just these pockets of explosive behavior that we're starting to see really, really formulate here. Now, the last chart I want to bring up before we start discussing some of the stories and get into the meat of the tariffs and what that means, the Canadian OTRI. So this is a good segue too, because this is the outbound tender rejection index for Canada. So this is loads coming from Canada, and it could stay in Canada or it could be crossing the border. A lot of this freight does cross the border, which is why you see a spike in the rejection rate coming out of Canada. Canada spot rates, of course, increased significantly this week. Canadian OTRI increases. Two things happen here. One, not enough capacity, but two, spot rates being elevated over contract rates means carriers are going to prioritize getting a lot more money. And something we saw with the tariffs is that the shippers weren't necessarily planning on moving this freight today or at the end of February. But as the tariff became more likely, shippers were forced to say, you know what, I will pay 2 to 3x to get this into the country in front of these 25% fees. And the carriers aren't ready for this. because this is outside of their normal scope of business. And so these rejection rates are reflective of that, is that it may not be necessarily, because we're not necessarily seeing contract volume increase, but we are seeing spot rates increase meaningfully, and it's also reflected in the tender rejection rate increasing.
So this is a very good thing for carriers. I mean, just to have the pricing power in their favor again, but it's not going to be a very long-lived influence.
Exactly. That was going to be my next point, is that this is not a sustainable environment. This is a very short-term flash in the pan for that Canadian thing. Now, we did just hear that there's the potential. I don't know if they've definitively said about pausing the tariffs out of Canada for auto manufacturers, which
they have.
If that has happened, then yes, this is probably going to be a little bit of a pause. I don't know that the rejection rate is going to come all the way down, because now they have 30 days, but it should come down somewhat here in the next few days, I would expect. With that being said, a few things from the supply chain perspective. Now, before we get into the meat of the discussion about the policies and things like that, I want to say that I am trying to avoid any kind of political, discussion here. That is removed from the table entirely. I myself am politically agnostic. I would rather not get involved in that, but we're trying to say what is happening and what does some of these policies reflect and mean. It's very challenging to do this, but I'm going to try my best to keep it that way. China sells Panama Canal to a private equity firm. I think this is one that most people would say bipartisan. I don't know that this is necessary. This was a security thing he wanted done. I don't know that it has a huge influence over anything directly today. What are your thoughts here?
So I think one of the comments from the Hong Kong-based holding company that sold the ports was that it was a very elegant solution, right? Yeah. So it doesn't get nationalized to the U.S. It doesn't remain with China. It's just kind of, it's elegant in the sense that everybody's kind of happy, but really nobody's satisfied. Right. So I agree with you. I don't think this is of too much import. The Panama Canal was dealing with issues beyond, geopolitics. And so as we see those drought conditions abate, it should be more active, it should be cheaper, I think, regardless of who owns it. But if you were worried that this was going to be a security threat, then you can sleep a little bit more easily now.
Yeah. I don't know that this is going to be, I can't foresee anything that meaningfully disruptive or otherwise coming out of this, other than now you can just stop talking about the Panama Canal a little bit, unless there's another drought, of course. So the next thing up for the maritime space, Trump says U.S. plans tax breaks, investment, and shipbuilding moving forward. Now, this one, I'm not so sure. This feels good in general for shipbuilding in America, but I don't know. It takes a long time to build a boat. And I don't know that there's going to be anything in the near term that comes of this. Do you think this is a strong, neutral, or a negative impact overall?
So my cousin is actually a shipbuilder down in Mississippi. And yeah, when you say it takes a long time to build a boat, it takes a long time to even conceive of the planning of a boat. So it's what we've seen right now from Trump's address to Congress the other night was that these spending proposals can be undone by the next administration if they're so inclined.
Right.
And so given the timeline it takes to build capacity, also just the trend in which the whole industry globally has been kind of teetering on overcapacity, I would say they were spared from the consequences of that overcapacity due to the Red Sea. But now that things are quieting down, there's a lot of capacity in the maritime sector. So we'll see how much this pans out and if it even gets to the finish line.
Right.
Just
And they are talking about the administration is talking about potentially levying some form of tax on non-U.S. carriers at these ports, which is also a little bit of a tariff influence. So I think one of the components of the Trump administration that necessarily hasn't manifested clearly yet is that he does historically like to stimulate things via tax cuts. That has not been clearly laid out as of yet. There are some things that have been thrown out there in the future, but that we haven't seen that yet because we've been so focused on the near term of like, what do we do about all these tariffs and some of this, the fentanyl, I think we can agree is a little bit of yes, it's an issue, but it's also a little bit of a diversion from the fact that I think the end goal is still to bring manufacturing into the United States, correct?
Right. And I think, when you have these different aims, right, you have the reshoring of manufacturing, you have the fentanyl crisis, you're going to have to sacrifice something.
Mm-hmm.
You know, you can't just rebuild manufacturing capacity overnight. There's going to be
Yeah.
some pain. Many believe that the pain might be worth it in the end, but it's going to be pain.
Yeah.
So you can have a diversion like the fentanyl crisis and say we're making progress on this one front while we wait for this other front to be developed further.
Right.
So
And I think the big question for a lot of our audience and of course the world is, what do we do about this? When you talk about hearing fentanyl is the reason for a 25% tariff, even though you know that it's not the pure reason in general, because it becomes a wartime declaration that you can now implement tariffs because of something that's not related to trade. Does this? How do you as a company kind of deal with the fact that these tariffs appear to have a couple of end game results, and some of those end game results don't necessarily have anything to do with one another? Like fentanyl, for instance, not necessarily having stuff to do with reshoring.
right. I wrote a piece, and this is maybe cold comfort to people that actually have to deal with the everyday logistics of running a company. But I wrote a piece the other week, which was kind of arguing that a trade war with Canada or Mexico or China would disproportionately disfavor Canada or Mexico.
Right.
So we would be hurt, but they would be hurt worse. And
Right.
so that's kind of what war used to be. It's just that whoever taps out, cries uncle, loses the war. Canada is getting very fired up, very patriotic right now.
Right.
Prime Minister Justin Trudeau can afford to do that since he's somewhat of a lame duck. So he can just go, blazing in a blaze of glory. But that I think will evaporate once Canadians and Mexicans see like the effects. But then again, the American consumer has basically pushed Trump into the White House because of inflation. I would say was the primary issue. And if they see a return of that, they might get angry too. So again, which one's going to revolt first? Which one's going to cry uncle? I don't know, but it's
What about the American companies who have business and dealing? Obviously, the auto manufacturers have a lot of this, and we get a pause on that for 30 days. But what do we do about that? Like, there's a negative influence to American institutions. Is that a factor in this as it plays out?
How do you mean negative influence?
In terms of they now have to deal with passing on the cost,
Right.
potentially hurting their demand. I know it's been levied that the cars in the future will be a tax write-off like a mortgage is, which would be kind of a, that pulling back component. So is there some sort of negative influence to America, though, when these tariffs get levied that is kind of a counter influence to all this?
So far as I know, 30 days is really nothing. It's a buffer, but it's not enough to just kind of
Obviously, there's not a lot that can happen.
Right.
Yeah.
But there is also another buffer in terms of car inventory, from what I remember. So there are a lot of unsold cars on the lot. Dealerships and automakers can kind of rest easy on those laurels for a little bit. But when it comes to actually reintegrating the North American supply chain just into the U.S. is going to be a big ask, and we simply just don't have many of the resources, the minerals that you need to make a full modern car. I don't think, and I don't want to speak for any company in particular here, but I don't think that companies expect this hostility towards Canada and Mexico to continue. I think it is very clearly a ploy. It's going to be in the short term, but then again, who knows, right? So you can make this guess, and then overnight it'll change. But no, I don't think that Canada and Mexico will remain separate from the North American auto industry for too long. And I think we see some indication of that given the 30-day pause. There's some preferential treatment there.
I think one of the biggest things I hear is that people are just very uncertain about what the purpose of a lot of this is. Like, what's the end game? What is Trump going to want? It's not like all of a sudden we're going to have plants, like you say, in America that can manufacture all this stuff. We don't have the resources to finish some of these goods that we want to make. And we're going to have trade partners. It's not like trade's going to go away necessarily. So in that, there's a risk of, while we're going through all this aggressive negotiation, the economy stagnates because there's a lack of clarity in terms of direction. What are your thoughts on stagflation and the potential there? Do you think we get clarity? A lot of these companies are already kind of stalling out their decision-making, and CapEx hasn't been a thing for a while already. Does this just kick the can down the road a little bit further?
So there are a couple of things there. If you'd asked me 3 years ago if I thought stagflation was a risk, I would have said yes. I still think it is, but it's been around for so long that I just don't even know if it'll ever come into being. And I think part of that is based on the kind of frustrating realization that when you look at the US economy, you're looking at the US consumer. When you look at the US consumer, you're looking at US consumer psychology, right? A lot of this you can look into the numbers or spending patterns or whatever, but really it's just the sentiment, and it's something that's very hard to gauge at the end of the day. So am I worried about stagflation for the broader US economy? Yes, but I've been worried about that for a while, and I can't afford to lose any more sleep.
Well, we did see the consumer indices, also the business indices dropped in the past month significantly. Consumer confidence, the University of Michigan, of course, publishes this. It dropped from a 71 to a 64 or something like that in February. And that was in front of the tariffs.
Right.
And all this stuff. So, and now it feels like that has been exacerbated here in the past few days. Now, agree or disagree with the policies itself, there does appear to be an overriding sense of confusion. And when you don't have the ability to plan forward, and we haven't seen this manifest yet, and necessarily in a strong way, but some of these sentiment indices, which for people that have watched this show for a while know that I'm not a big fan of, because it doesn't necessarily mean that it's going to manifest into anything. I like to look at what people are doing, not what they're saying or feeling, but this does look like something that may show up in some of the figures here in the coming months.
Right. So, the other part of that stagflation, when you talk about the elimination of capital expenditures for a while, is what is the Fed going to do, right? The big risk that people have been talking about is that tariffs will incite inflation again, which has already been kind of resurging, and then the Fed will have no choice but to hold rates, or even in the most absurd scenario, like raise them again, which I don't see happening, but might happen. But on the other hand, if this is so deleterious to the U.S. economy, then, it will trigger a recession, in which case, unemployment will rise and the Fed will have to lower rates immediately. So, or, they probably will. So then again, what does a business make of this? There's a lot of confusion to go around. I agree with you there. I don't think the Fed has any more clarity, much more clarity than I do sitting here.
Yeah, and we're in a weird time of year to see things manifest from the data perspective. We're normally, like when the pandemic ended, the IOTI, the bookings index, it didn't respond right away. It took several months for companies to stop ordering goods. I don't know if that's going to be true here or not. But some of the early warning signals were there in January, February LMI data that we talked to Dr. Zach Rogers about a little bit ago, in the way that inventory levels grew faster than anticipated. Now, from a seasonal perspective, this is not a big warning sign because this is what we expect to happen in January, February, and March even to an extent. I don't know if there's anything economically that you're looking at that is going to be kind of a precursor, some of the best data. I think labor is one that I've heard is probably one of the better ones as these companies maybe hold on some investment. I don't know what your thoughts are there.
Right. So we have the jobs report coming out tomorrow on Friday. So that'll be one to watch. We had a sneak preview with the private sector employment. And this is actually Thomas Wasson, friend of the show, sent me the other day, was that employment in 2023 and 2024, government jobs made up about a quarter of the hiring there. In 2021, 2022, it was about 5 to 7%, right? I think we're going to see a return to some of that 5 to 7%, given the current administration's aims. So we'll see, what happens with the government. But the private sector employment report was pretty mixed, I would say. But the one sector that was hit the hardest was transportation. And that goes along with capacity leaving the market. So we're continuing to see that. Construction was up, though. Construction was up, I think, 26,000 jobs in February.
Wow.
And manufacturing was up about 18,000. So
it does look like that there is some sort of push-pull effect, economically speaking. We've got some sectors that are hurting worse than others. That hasn't changed. That's relatively an ongoing thing. We've seen some of the sectors exceed while others have suffered, et cetera. But from my perspective on the transportation market, a lot of the supply chain managers are still thinking this year has a risk of having a transportation market flip where things get tighter. We started the show with this. There's still that inherent risk. What you just said about the transportation jobs figures. This market has been struggling to hold on to, a way to utilize what they have currently already. They're still correcting towards the lower side, which means that if we do get clarity on the economy moving forward, that this is one of the most vulnerable markets in the transportation side that we've ever had. And that's probably true of any post-recession, freight recession environment. But this one feels like it's only digging a little bit deeper.
Right. And unlike the pandemic, it's not a black swan event. Everybody's holding their breath and waiting for it.
Yeah.
I will say that when you look at manufacturing sentiment, it has been very positive. And it goes back to that thing you were saying about, waiting for it to flip.
Yep.
Manufacturers, I think, are ready for their optimism to be burst within the next 6 to 12 months, right? They're very optimistic right now. They have a lot of new orders, a lot of front loading, but I think they're prepared to kind of have that trickle off pretty soon. If we're looking at freight demand, though, I mean, we have a lot that needs to go places, right? Are they going to slow walk it on the rails? Yeah, probably. We've seen a lot of that
Been
with
doing it.
intermodal, but the trucking market's going to get fed either way, and so I think there's a lot
that's
of
the
stuff here.
one risk you can count on this year of holding strong. There's a lot of fogginess around multiple sectors and other parts of the economy, but I still think the transportation market is probably one of the most vulnerable this year.
Right.
All right, everybody, have a great week.